Good day to our lecturer, Dr. Ine. Today we'll be presenting our business proposal assignment. Hello, my name is Nur Farahin, matrix number 2400286, and I am the leader of this group. Next, we have Abdul Naim, Jasmita Adeline, Hana Maisara, Nur Arisha, and lastly, Muhammad Adam Firdaus. For this business proposal, our company is an accessories retail shop named Loopyssories. Loopyssories operates under the retail or merchandising sector, which means we do not manufacture product ourselves. Instead, the business purchases finished goods such as bracelets, rings, bags, hats, and earrings from suppliers. These products are then resold directly to the final consumers through our retail outlet. This business model allows Loopyssories to focus more on product selection, branding, and customer experience rather than spending resources on production processes. As a result, the business can respond quickly to fashion trends and consumer preferences. In terms of market viability, although the overall retail industry experienced a contraction in 2025 due to cautious consumer spending, the long-term outlook for this sector remains positive. Industry data indicates a compound annual growth rate of 5.94% until 2023, showing sustained growth potential. Our target market consists of affluent urban consumers who tend to continue spending on discretionary items such as accessories. Even during periods of economic tension, this group prioritizes self-reward and lifestyle purchases. Additionally, Loopyssories benefits from a low barrier to entry. As a merchandiser, the business does not require heavy capital investment in manufacturing equipment. This significantly reduces startup costs and operational complexity. Therefore, management can focus its resources on brand development, marketing strategy, and delivering a premium customer experience. Next, the profitability of Loopyssories is supported by our strategic focus on the affluent income segment. Specifically, household earning more than 12,000 ringgit per month. This group has a high level of disposable income and spend more on non-essential items, with average online spending of approximately 786 ringgit per month. By targeting this segment, the business aims to maintain a 50% gross margin, which is necessary to cover the fixed operating costs associated with premium urban retail location. In terms of brand relevance, Loopyssories aligns its product mix with current and high-growth fashion trends. These include smart jewelry that combine functionality with modern aesthetic, as well as sustainable accessories. This approach not only meets changing consumer preferences, but also aligns with the Malaysian government's guideline on sustainable and circular fashion, ensuring long-term relevant and responsible business practices.
Hi, my name is Abdul Naim. So for this section, I will explain the required capital and the rationale behind it. Based on our budgeted financial statement, the total capital required is 60,000. This amount is made up of two components, cash capital injection and non-cash capital injection. So for the 30,000 come from cash capital injection. This represent the opening cash balance at the beginning of January. So the owner deposit this amount into the bank account before operation begins. This cash is used to cover the first month's operation expenses such as rent, salary, and initial inventory, and it provides sufficient runway before sales revenue is generated. Secondly, the remaining 30,000 is non-cash capital. This refers to equipment valued at 30,000, which is recorded in the balance sheet. The equipment was contributed by the owner, which explains why there is no cash outflow for the equipment purchases in the cash budget. Together, these two components bring the total required capital to 60,000. Now, I will explain our intended budgetary process and the budgeting approach used. Loopyssories adopts a participative or bottom-up budgeting approach which is suitable for organizations operating in a dynamic and customer-oriented environmental like retail. So this approach is chosen because frontline employees have direct interaction with customers and therefore possess better operational knowledge about customer preference, sales trend, and inventory movement. Additionally, this accessory retail industry is highly trend sensitive, meaning forecasts needed to be adjusted frequently. A participative approach allows for faster and more accurate revisions.
Here, our master budget preparation. Firstly, we do assumption, and then we have sale budget, purchases budget, selling and administrative budget, cash budget, cost of a goods sold budget, income statement, and balance sheet.
Now, I will explain the assumption used in preparing our master budget. Firstly, the selling price and the average cost per unit are assumed to remain constant throughout the 3-month period from January to March. So, the opening cash balance at the beginning of January is 30,000. In terms of sales, 70% are cash sales, while the remaining 30% are credit sales, which will be collected in the following months. Payment to suppliers are made 60% in the current month and the 40% in the next month. So, ending inventory is remained at 20% of the following month's budgeting sales. We also assume there is no owner drawing. Operating expenses also remain fixed every month, and each customer purchases only one item. These assumptions help ensure consistency and accuracy in preparing the master budget. That's all from me. I'll pass to my next friend.
Hello, my name is Desnita Adeline Roma and my matrix number is 240028883 and I will present our company's sales budget. We start with the sales budget in the units for the first quarter, which include January, February and March. Our business sells 5 types of accessories, and from the table, we can see that the sales unit will increase each month for all products, indicating a growing in demand. For example, the bracelet sale increased from 150 units in January to 190 units in March. Overall, the total budgeted sales are 620 units in January, 700 units in February, and 780 units in March, resulting in a total of 2,100 units for the entire quarter. This sales budget helps management to plan inventory, purchasing, and operations effectively. Moving on to the next slide. This slide presents the sales budget in terms of revenue measured in Ringgit Malaysia. The revenue is calculated by multiplying the budgeted sales unit with the selling price of each product. As shown in the table, the total revenue increases every month from 33,480 ringgit in January to 42,120 units in March. Among all products, bags generate the highest revenue with a quarterly total of 28,500 ringgit, followed by bracelet and rings. The total revenue for the quarter is 113,400 ringgit. This revenue budget is important because it shows the company's expected income and helps in planning cash flow and profitability. Now let's take a look at this table. This table shows the merchandise purchase budget in units for the first quarter. Expected sales increased from 620 units in January to 780 units in March, totaling 2,100 units for the quarter. To maintain smooth operations, the company keeps a desired ending inventory of 20% of the following month's sales. After adding desired ending inventory to the units sold and deducting beginning inventory, the units to be purchased are 760 units in January, 716 units in February, and 796 units in March. Overall, the company plans to purchase 2,272 units during the quarter to meet the demand efficiently. Now let's move on to the merchandise purchases budget in RM. This table converts the unit budget into monetary terms. And based on the planned purchases, the total purchase costs are 22,040 ringgit in January, 20,764 ringgit in February, and 23,084 ringgit in March. This results in a total merchandise purchase cost of 65,888 ringgit for the quarter. This budget helps management to plan cash outflow and ensure purchasing decisions are aligned with expected sales and inventory requirements. Now we are moving on to the selling and administrative expense budget for the same 3-month period. The expenses include rent, salaries, utilities, advertising, and variable selling expenses. Most expenses such as rent, salaries, utilities, and advertising will remain constant each month. However, the variable selling expenses will increase each month, which is consistent with the rising sales activity. Total monthly expenses are 9,230 ringgit in January, 9,350 ringgit in February, and 9,470 ringgit in March. Overall, the total selling and administrative expenses is 28,050 ringgit for the quarter amount. These costs are well controlled and increase only slightly across the quarter. Now let's discuss about our company cash receipt budget. Our company collects 70% of sales in the month of sales, while the remaining 30% is collected in the following month. For example, for January, 70% of January sales equals to 23,436 ringgit, which is collected in January, and the remaining 30% is collected in February. The same method is used to calculate for February and March. As a result, the total cash collections are 23,436 ringgit in January, 36,504 ringgit in February, and 40,824 ringgit in March. This gives a total quarterly cash collection of 100,764 ringgit, showing a strong cash inflows aligned with the increasing sales for each month. That is all from me. Thank you.
Hello, my name is Hannah Maisara bin Ruslan, matrix number 240028878. Now I will be presenting the second part of our master budget. First, let's take a look at the cash payment section of the cash budget. Our business pays 60% of purchases in the month of purchase and the remaining 40% in the following month. For January purchases, 30,224 is paid in January and 8,816 is paid in February. For February purchases, 12,458 is paid in February and 8,306 is paid in March. Lastly, for March purchases, 60% amounting to 13,850 is paid in March. As a result, total cash payments are 13,224 in January, 21,274 in February, and 22,156 in March. Overall, total cash payments for the quarter equal to 56,654. Next, this slide presents the complete cash budget statement for 3 months ended March 31. Our business begins with an opening cash balance of 30,000 ringgit in January. Cash inflows come from sales collection, 23,436 in January, 36,504 in February, and 40,824 in March, giving total cash inflows of 100,764 for the quarter. Cash outflows includes purchases and selling and administrative expenses. The total outflows for the quarter amount to 84,704. After considering both inflows and outflows, the ending cash balance is 30,982 in January, 36,862 in February, and 46,060 in March. This results in a strong closing cash balance of 113,904 for the quarter, indicating good liquidity. Now let's move on to the cost of goods sold budget. Our business starts with no opening inventory. Total purchases for the quarter amounting to 65,888, which represents the goods available for sale. Closing inventory is calculated as 172 units multiplied by 29 ringgit per unit, giving 4,988 ringgit. After deducting closing inventory from goods available for sale, the cost of goods sold is 60,900 ringgit. This figure will later be used in the income statement to calculate gross profit. Here is the budgeted income statement for the 3 months ended March 31. Total revenue for the quarter is 113,400. After deducting the cost of goods sold of 60,900, the business earns a gross profit of 52,500. Selling and administrative expenses amounting to 28,050. After deducting these expenses, the business achieves a net income of 24,450 for the quarter, indicating profitable operations. Finally, let's take a look at the budgeted balance sheet as at March 31st. On the current assets, cash is 46,060, inventory is 4,988, account receivable is 12,636, giving total current assets of 63,684. Non-current assets consist of equipment worth 30,000 ringgit. This brings total assets to 93,684. On the liability side, account payable amounting to 9,234. Owner's equity includes opening capital of 60,000 ringgit and net income of 24,450, resulting in closing equity of 84,450. Total liabilities and equity equal 93,684, which balances with total assets. That's all from me. Thank you.
Hi everyone, my name is Nur Alisha Umaira binti Mazlan and my matrix number is 240000732. In this slide, me and Adam will explain about the implementation of activity-based costing, which are also known as ABC. First, we have the major activity and cost pool. Second, we have the cost driver. Third, we have the activity rates. Fourth, we have the implementation of ABC. And lastly, we have the benefit of ABC. So let's look through all of them. For this section, I will explain how we identify major activities and separate overheads using activity-based costing. First, we identify the major selling related activities to outperform for every unit sold and therefore drive variable selling costs. These include packaging products, processing sales transactions through cash, card, or e-wallet, handling and delivering sold items, and providing sales support such as commission or incentives. Next, these variable selling overhead are grouped into distinct activity cost pool based on the nature of each activity. This cost pool include packaging activity, transaction processing, delivery and handling, and sales support activity. It is important to note that only variable selling overheads are included in this analysis. Purchasing costs and fixed store operating costs are excluded as they are treated separately in the master budget.
Hi, my name is Adam Firdaus and my matrix number is 240000511. So, for this section, we identify the cost drivers for each major activity. First, for packaging activity, the cost driver is the number of units sold. This is because every product sold needs to be packed, so when sales increase, packaging work and costs also increase. Next, transaction processing uses the number of sales transactions as its cost driver. Each sale requires payment processing, invoicing, and system handling, so more transactions lead to higher processing costs. For delivery and handling, the cost driver is the number of units handled. The more products that need to be moved, stored, or delivered, the higher the labor and logistics costs. Lastly, sales support activity is driven by the number of units sold. When more products are sold, more sales effort, customer service, and sales incentive are required. Overall, these cost drivers help us understand what actually causes costs to increase, making cost control and pricing decisions more accurate. Next, to estimate the annual activity level, we start with the master budget. The company expects to sell 2,100 units per quarter. Since there are 4 quarters in a year, we multiply 2,100 by 4, which gives us 8,400 units annually. This means all cost drivers in our activity-based costing system will be based on 8,400 units per year.
Next, we compute the activity rates. The total variable selling cost for the year is 12,600 ringgit, which based on the 8,400 units times with the 1 ringgit and 50 cents. For each activity, we divide the annual cost by the annual activity level. For example, packaging cost is 4,200 per year. When we divide this by the 8,400, the cost is 50 cents per unit. Similarly, transaction processing cost of 3,360 ringgit, giving a rate of 40 cents per unit. Delivery and handling and sales support each have the rate of 27 cents per unit. When we add all the activity rates together, we get the 1 ringgit and 50 cents per unit, which matches the total variable selling cost per unit.
So, to apply activity-based costing, we use a simple formula, which is ABC cost equals units sold multiplied by the ABC rate. We already calculated the ABC rate earlier as 1 ringgit and 50 cents per unit, which represent the total selling overhead cost per unit. Now, we apply this rate to each product. For example, bracelets sold 2,040 units in a year, so the ABC cost is 2,040 units multiplied by 1 ringgit and 50 cents, so we get 3,060 ringgits. For rings, the calculation is 1,920 units multiplied by 1 ringgit and 50 cents, so we get 2,880 ringgit. We repeat the same calculation for bags, hats, and earrings. When we add all the ABC costs together, the total is 12,600 ringgit, which is exactly the total annual selling overhead cost. This shows that the ABC system has fully and correctly allocated all overheads to the products. That's all from me. Thank you.
ABC provides several important benefits to the business. First, it gives more accurate cost allocation because overheads are assigned based on real activities instead of using one blanket rate. Second, it improves the understanding of cost behavior by showing which activities, such as packaging or transaction processing, are causing costs to increase. Finally, ABC helps management to make a better pricing and profitability decision because it shows the true cost of selling each product. This leads to more informed and competitive business strategy. That's all from me. Thank you.
Overall, Loopyssories present a well-planned retail business supported by effective managerial accounting practice. The integration of structured budgeting, data-driven analysis, and activity-based costing enhance operational efficiency and support managerial decisions. The master budget demonstrates carefully planning and control, ensuring sustainable operation and financial stability. While business risks cannot be fully eliminated, ongoing monitoring and flexible budgeting allow the business to respond effectively to the changing condition. In summary, the managerial accounting framework adopted provides strong basis for consistent performance and future growth.